Welcome to the True Commercial Real Estate Podcast, your ultimate investor resource for all things truly commercial. Whether you're interested in industrial, retail, medical office, storage, single tenant, or any other type of non-residential real estate investment, this is your podcast.
Welcome everybody for this very first episode of the non-residential commercial real estate podcast. I'm here with my co-host Logan. I'm Aurélien, and tonight we will be interviewing Jacob. Jacob will tell us about medical and syndications, and so we're going to try to do a high-level interview so that people get a good insight into the medical space. So, Jacob, could you please start off by telling us a little bit more about yourself in general terms?
Sure. So out of school, I went to a normal college, and then out of school, I was working in environmental consulting, and found that to be extremely unrewarding, and found that working a job in which I had billable hours was extremely unpleasant. And so I looked around for other alternatives and was actually inspired by my wrestling coach from high school way back when. And he ended up making it on one of the Bigger Pockets podcasts, which was pretty cool. Gabe Hamill, in case anyone's curious. And he does a lot of residential, mobile home parks and lower income residential. And I didn't necessarily want to do that, but I thought I wanted to get into real estate. And so about 2.5 years now ago, I got into some real estate, found an opportunity to get in, and it's been great ever since.
Thank you. Can you tell us why you got into a non-residential commercial real estate and more particularly medical?
Yeah, sure. So starting out, I realized pretty quickly that it was going to be hard to, as my first property or second property or whatever, get into a large residential. And it felt like at the smaller scale, single family, even duplex, triplex, fourplex, it's kind of a pain in the ass to have residential tenants. There's a lot of management that goes into it unless you can find an amazing property manager. And I didn't have that connection. And so it just, didn't make sense to me. And so I looked towards commercial, and, as many people here have mentioned, heard that commercial was, the way to go. It's way more hands off. It's where all the money is. And found that to be true. My partner is a physician and had some experience in the medical office space, the person that I'm working with. And so that was the logical place to start because he had that expertise. But I also really like the asset class. I think it's only great if you're looking for the reasons why I think it's great. It's really stable. You've got a lot of government backing. You got long-term tenants, people who set up their practice and don't move for 40 years and don't even ever think about moving. And another thing is, it's just so defensible. It is hard for just your everyday investor to get in because the price tags are a little on the high side, even at that smaller level. You're not going to find a good office for probably less than $1 million, or less than at the very least $500,000. So you got the high price tags, and you've got such particular tenants. I mean, everybody you talk to who knows a physician or, has a physician as a partner or something, is going to say, oh yeah, physicians, they're brilliant. They're great people, but they're so strange in some ways. And so no offense to physicians who are listening to this, but there are certain ways you need to understand how to work with your tenants to make that partnership succeed. So,
okay.
Yep.
Awesome. Okay. And can you tell us about your very first medical deal? Can you walk us through that one?
Yeah, sure. So that was an ophthalmology clinic in Olympia, Washington. And my partner we found the deal because my partner had done had purchased an ophthalmology center previously And then the physician at that center referred us to his friend because he liked working with us. So we ended up in Olympia, Washington, and it was a $2.1 million building. I believe that was 8.4 cap with 5-year triple net leases and 2 5-year renewals. And one great benefit to that deal is that the ophthalmology center is managed by a regional ophthalmology corporation. And so they have professional large-scale management in place. So we didn't have to worry about, just a group of doctors winging it, essentially, which is kind of a risk that you run in medical and you need to watch out for. And so that was the first deal. And the way that we funded it is that that one we did not syndicate. We just pulled in some partners for capital, more on like an even partners basis, although we got more equity because we put in the work. So some of that, sweat equity.
Very cool. Do you mind if I comment on one thing real quick?
Go ahead.
Yeah, that's interesting. You think about it in traditional retail or other office or other industrial tenants as like, the caliber of the tenant. I guess it would be true that would ring true with office as well, having, a startup physician who hasn't gone into business before versus, this regional company. That makes a lot of sense. Not something I've thought of before. As clientele, you would just think, okay, a doctor's coming in. This is great. I've got a doctor as a client, but it makes sense. Yeah.
Yeah. And I'll just add another thing to that while we're on that. An interesting detail about medical is that because the doctor themselves is so important to the practice or the doctors, the age makeup of a practice is an important thing to look at with medical. If I'm buying a practice and they say, oh, we'll sign a 10-year lease, but all the docs are 60 to 65, like, they might just walk away unless they sign personal guarantees. So, I do want that established practice. I would really like the regional management, but I would also love to have, like 35 to 40-year-old docs who I know are going to be there for a lifetime of a career.
Cool. Yeah, that makes sense. What size was your latest deal?
Well, I'm going to actually address a deal that we just walked away from. It's a little more interesting. We had a deal on a spine surgery center and office combination, and that was going to be a $3.2 million purchase. And we ended up walking away because we found what we thought were significant issues during diligence, and we brought those up, and we thought that the price should be dropped back down to probably around 2.8. And the appraiser ultimately agreed with us, and the seller decided that they would rather try their luck back on the market. And since that was a deal that we were going to be syndicating, we actually had fully fundraised. We were completely committed to it, or we had full commitments. We just couldn't go ahead with an overpriced asset, especially because it was other people's money. So that was the most recent size that we were about to give the money in on, and then had to walk away. But on the other end of the scale, I have one that will close, and I don't foresee us walking away for any reason at the end of the month. And we're going to pay $200,000 for it, but it will be a 50 cap. So there you go.
Who's the tenant?
The tenant is Mosaic Health. They're kind of in the center of the company, or the center of the country, rather. So Missouri and maybe parts of Kansas and that region. We're buying it from a really tired out landlord who just doesn't want it anymore, doesn't want to deal with renewing the lease, and so we're going to take it for $200,000.
Nice.
Yeah.
And how did you come across that one?
That was me combing through the listing sites. I like our off-market deal flow more, and right now we have such a strong off-market deal flow that I don't actually go on Crexi or LoopNet anymore. But I found that one at one point looking through there and thought it looked like something weird was going on, and so ended up calling up the broker, and something weird was going on, and the price started at 2 million and now it's 200,000. So
That's all from negotiating?
yeah, negotiating and waiting patiently.
Sounds good. So we figured we would deep dive with you into a particular deal, and
Sure.
so can you tell us about the property to start, and what did you like about the property?
Yeah. So for this, I was thinking about talking about a deal that we did in Sacramento. It was not a syndication, to be clear, but I did like the deal a lot and thought I would dive into it, if that's all right.
Sure.
Yeah. So this was a small office and surgery center in Sacramento, California, referred to us by another seller who enjoyed working with us. So the things that I really liked about it is again, it was managed by a regional healthcare management company. It had surgery center capabilities, so that automatically is going to make something more valuable because the cost of replacement is so high for surgery centers because of all the regulations. And this was another case, like almost all of our purchases, where the physician selling was this was a physician selling, but the person selling was really tired out, just wanted to be able to retire, didn't really need the money from the sale to retire, but wanted to no longer have any sort of responsibility in the real estate. Just walk away, go golfing. And so we got a great price on it. And so, it's in Midtown Sacramento, and, we got a 9.2 cap and way below cost of replacement. And so I liked all of those things. And the last thing I liked is that the doctor was going to stay on for another year as part of the lease back. But before we closed, we established that there was a clear succession plan from the doctor who sold us the building and who was retiring and was totally done, to a new younger doctor and two younger doctors coming in. And so we felt that, we had the replacement value checked out. The cap rate was great. The location in Midtown Sacramento felt really solid. And we knew that the practice had a future.
Interesting. And how do you find new doctors? Like, for example, if you have a doctor that's going to retire, do you go to a medical school and advertise on the billboard there? Or?
Oh my gosh, that would be a trip. Well, that's one great thing about working with the the national or regional healthcare management companies, is that they own the business, or they at least own part of the business, and so they are highly incentivized to find a new doctor, or their business, one of their business locations just vanishes, and they've already invested in it, and they have a lease that they're responsible for. And so I don't have to find a doctor. They're going to go find a doctor because it's their bottom line that's going to get crushed if they don't.
Interesting. Okay, so that's it mainly for my questions. And Logan, if you want to talk about the syndication with Jacob.
Yeah, if you don't mind us diving a little bit into how you put these deals together.
Sure.
Dive into that. I think some other people on the line would like to hear a little bit more about that as well. Just kind of the syndication process in general. Take us back to the beginning. How did you learn about syndication? Did you take a course? Did you hire a mentor? Were you working with someone on your team who had done it before? Or did you just kind of figure it out?
Yeah, I did not hire a mentor, and I did not take a course. I think I heard about it for the first time pretty much right when I was interested in getting into real estate. So back, 2.5, almost 3 years ago, I pretty much binged all of the Bigger Pockets podcasts. Mm-hmm. Just went through, I think, pretty much up until Josh Dorkin left, and then I didn't like the new guys much, so I stopped listening to them. But I started at the beginning and just worked my way up. And they talked about syndications. I think Brian Burke in particular, Praxis Capital, talked about them a lot. And so I went ahead and read every single thread on BiggerPockets about syndications. And I read every article I could online about them. And all in all, essentially read a book or two worth of information. I know I started a few forum threads, at least one or two. Got a response from Brian Burke, which was kind of cool, because he's a pretty big fish in that pool.
Yeah.
And so that's essentially how I learned about it. And then the rest has been working with accountants and lawyers to hammer out the actual details, which nothing that I found touches on. And I felt that even if I had a mentor, I would still need to learn how to do that legal and accounting work for myself and hire somebody, because yeah, that part is complex.
Yeah, for sure. For sure. Yeah. I mean, I can imagine, especially with mentors, if you're not a CPA and you're giving advice, or if you're not an attorney and you're giving advice, you can get into a lot of hot water there, I'm sure. Or open yourself up to liability there. One of the questions we had was, what type of syndications you do, or how do you structure, the syndication?
Yeah, sure. So the way I structure it is it's just a GP LP. So my company, Fall Creek Partners, functions as the GP partner. And so if there's a personal guarantee on the loan, we're taking all of that personal guarantee. We're fronting all of the legal and accounting expenses. We're doing all the diligence, and then we operate as somewhat of a management company. Usually we'll hire a property manager anyway, but our company will interface with them. And then we'll bring in investors, and they'll all be limited partners, so the LPs. And then I would imagine you're going to ask me how we split value. And that's been something we're playing around with, trying to figure out the right way to do it. Because in a lot of deals that are value add in nature, it makes a lot of sense for the general partner to take, some admin fee to cover costs throughout the lifetime of the deal, and then to take, 20 to 40%, depending on the deal, depending on a lot of particulars, of the upside at the end. And that's how a lot of those work. And it makes sense because the deal isn't necessarily making any profit until they sell, but when they sell, they make a lot of money. Mm-hmm. But on the other hand, the way that we're running our deals, it's almost entirely income oriented. So there'll be some pop at the end when we sell. We're going to renew a lease. There will have been escalations, and we're going to sell, and it'll sell for more than we bought it. We hope, we think, when we buy it. But most of the focus is, getting people 8 to 10% cash on cash every year from day one throughout the deal. And so the way that we've run it is that the investors get a preferred return, and then above that preferred return, the general partner and the limited partner split 50-50, all profits. So if you ask somebody like Brian Burke on the forum, as I did, he'll say, oh, we're cheating the investors, because it should be an 80-20 split. But I don't really feel like I am, because I'm aligning my incentives with the way that the property is supposed to produce profit, which is stable cash flow over time. Sure. And because it's not such a large pop, that 50% above the preferred, we set the preferred high enough that the 50% we're making, not like we're reaping in most of the profit. We're just essentially skimming some off the top. So I feel pretty good about the preferred and then 50-50 split after.
Mm-hmm. Awesome. Well, we're going to get into raising a little bit of capital and how you go about that, but I imagine, these people are pretty comfortable with the returns they're getting. If they sign on in advance, knowing they have 50% of the upside and there's 8 to 10% cash on cash return, and they like that, then I don't see any cheating involved there. So,
right.
If they like that return, that's their money. So, but yeah, that's awesome. That's awesome. So going into that, so how do you raise the capital? Are you looking, is it family and friends? Do you have like direct colleagues? Are you advertising? I know there's different roles there with advertising because you're selling securities basically. So
yeah. So anybody doing this, you can't just advertise openly. if you get caught, it will be bad for you. So don't do that. So yeah, we started family and friends. We've tapped into physician networks, both my physician partner, as well as the physicians that we've worked with in the past, particularly people who we've purchased buildings from, like to then invest with us, which is fun.
Cool.
We're working on some 1031 exchange strategies so that a physician could 1031 into an offering with us, but that's down the line. So yeah, friends, family, physician networks. I've had a few people from Bigger Pockets contact me, including Ed. And it was fun to chat with him. Another guy. And then I've been reaching out to family offices, single family offices primarily. And I imagine most people are familiar, but for those who aren't, a family office is kind of an organizational structure, but sometimes they're not very organized, to manage the money for one family that is very wealthy. And often that's 50 million plus in assets, and can be up to, many billions.
Wow.
I'm sure Jeff Bezos has a multi-billion dollar family office. So I've been reaching out to sort of the mid-range of those because they might be interested.
That's great. So it's
getting
like,
some positive.
so
Sorry,
it's
what?
like a CFO for your family, basically.
Yeah, and some people do hire somebody like a CFO to work for their family, and some people just wing it within their family. It's really interesting to see the differences as I talk to them all.
Yeah, very cool. Very cool. Awesome. So you're finding deals, you're putting the financing together, you're finding investors. What's the timing like between all that? From the time a great deal comes across your desk to the time you raise the funds, and then when you close, what's that typical time frame?
Oh man, that's a hard question to answer. I would say it's totally variable. A standard deal is probably going to be like 60-30, 60 for diligence, 60 days for diligence, and then another 30 to close. But pretty much no deal is standard. So this one that, for example, the like $200,000 building that I'm going to buy, we originally contacted them in September. We talked to them a little while and decided, no, we're not going to do this for $2 million. We walked away, and then they got back in touch with us, and we decided, okay, we'll do it for 200,000, and we're going to close in 30 days, but we're not going to finance it. We're just going to pay cash. And so, there's not as much diligence needed. A property that I'm looking at right now, I'm going to need to get leases written with like 8 different tenants. And so, that's going to be like a 6-month process if it happens. So totally variable.
Yeah. So in that process, you're getting it under contract, and then during that diligence, you're renegotiating those leases to get them signed. Is that before the bank will sign on to finance the deal? Is that how it's working? Yeah,
it's before the bank will sign on, but it's also before I would commit to buying it. Sure. And so whenever we're doing these deals, it's something, the way I like to think about it is that I'm doing value add before I'm committed to the deal. So in every purchase agreement that I sign where I think the lease needs work, I'm going to have a contingency that says I have 30 days, 60 days, 180 days to renegotiate the leases. And if I'm not satisfied, I can walk away.
Nice.
And if I walk away, like I've paid some legal fees for sure, but I don't lose anything else. And so then by the time that I commit to buying it, and I say, yes, I'll buy this, and I put down my money, I know I've already added value, which is pretty sweet, I think.
Yeah, that's awesome. That's really cool. One question I had about that, you had mentioned earlier that you had already raised the funds for a deal and then had to back out. What happens to those funds at that point?
So those were all commitments. We hadn't had the funds wired to us. So we were going to have them wired to us like the following Monday or something. We finally had to pull the plug after, working with them. And I was a little bit nervous about it because it was the first time I had to do that and say, actually, you should put your money somewhere else right now.
Yeah.
But we just wrote to everyone and we said, we gave the explanation that I gave to you guys pretty much. And everybody was really understanding and appreciated that we weren't going to just, run into a bad deal with their money. So
go forward without. Yeah, I'm going to dig into that just a little bit further on the timing there. So when you do a syndication and you have those funds and you have those commitments, what's that timing like before closing? Are they wiring that the day of closing? Are they wiring it a week before to put into an escrow account with somebody that's holding escrow until it closes? How's that work?
You can kind of design it however you want. We were going to have they were going to wire it in, and it was going to be 10 days before closing.
Okay.
It was going to go into an escrow account, and then we would just fund the purchase from there. Yeah.
Awesome. Yeah, the last question I have is more about advice for anybody who wants to get started. But really, do you have anything you want to throw in here before we jump over to that?
No, my question relates to the one you're about to ask. It's about, is there literature people can dive into to learn more about medical, about that particular sector?
Sure, I'll just answer it all together, I guess. So on the literature front, there's not a lot. There are certain companies that specialize in medical. So, I mean, mine for one, I started writing some blog articles. I'm not the greatest writer, unfortunately, but starting to put them on bigger pockets, which is fun. There's a company, Montecito Real Estate. I don't know if they've put out material. We've just partnered with them and are getting great deal flow through them, so that's fun. JLL, I can't remember, Jones, Lang, and LaSalle has a medical real estate division, and they put out some literature. Becker's Hospital Review will put out some literature, but most of that is on just the state of the medical market. It's not really a how-to guide. So I was planning to do some more blog articles, perhaps poorly written, but try to do a little bit more of the how-to. So that's what I would say on the literature front. In terms of other advice I would give to somebody who wants to get into medical, sounds like a few people on this chat right now have gotten themselves into medical, which is great. And if people wanted to get in a perhaps more systematic way, I would suggest either having a physician on your team or having a physician who you are friends with, trust, and can call on for advice to help you understand practice models and what actually makes sense in a practice financially. What's viable, what's not viable. You don't want to be flying blind because you're buying something and the docs say, oh, we do it in this creative way and it works really well. And you say, well, okay, but it's, doesn't make any sense from a reimbursement standpoint, insurance reimbursement. So that'd be one big thing. And then the other thing I would suggest is it will be extremely valuable if you can find a company to partner with for your deal flow. What I mean by that is make a friend at a national or a regional management company, whether it's surgery center, whether it's, ophthalmology specific, whether it's primary care, anything. Because once you're linked in with them and they like you and they trust you, they'll come back to you every time they need a new building or they need to lease something or, and that's going to be really valuable in terms of your deal flow and finding really high quality deals.
That's awesome.
Nice. And that's a value right there.
Yeah. I really knew you'd put something in the chat about asking questions.
Yeah, and just to say, just a quick comment. I really find it amazing, how in just a few years you've been able to establish yourself as a source of wealth on medical. That's really impressive. So yes, people, please, just for the consistency, we figured we would invite you to send questions through the chat so that it's the same voices that ask and talk. So I have two questions. One from Heath. When you started out, how were you able to bring in all the LPs? What about you or your deal made them feel comfortable to invest with you?
Bringing in the LPs at first was really about family and friends. And so they trusted me or my partner as people. And then looking at the economics of the deal, they liked what they saw. You know, we gave them a very conservatively modeled prospective cash flow and sale. You know, we modeled it out with a lot of conservative estimates in there. But mostly at the end of the day, they just trusted us as people. You know, I had folks say, yeah, well, you know, we'll put in 100,000 because, you know, we really believe in what you're doing. We really believe in you. We think that you're going to do a good job and you're going to find a way to make this work. And so at the end of the day, I can't say I'm a magical fundraiser. I just had, you know, I was fortunate enough to have great connections and my partner as well.
Awesome. So one other question we got is, what kind of fees are you charging for a value add deal? You know, acquisition fees, disposition fees, guarantee fees. What type of fees do you charge?
Yeah, sure. So to be clear, I don't think that what I'm doing is value. I wouldn't classify it as value add. Mm-hmm. I would classify it as probably core plus or maybe core plus plus. And when I say I'm doing value add before closing, what I mean is that it's still not a value add deal. It's still not at that scale of IRR. You know, that's usually going to reach like 20+% IRR. I'm not there. You know, if I can get 14, 15%, I feel pretty excited by the end of the deal. It's more about a really stable cash flow that's risk adjusted return is just kick ass. Mm-hmm. So just wanted to be clear about that. In terms of fees, right now we've been charging 2% acquisition fee. We find 2% of the purchase, and we find that is pretty good to cover the expenses in the meanwhile, the expense of setting things up. Mm-hmm. And then we've been offering a 6 or 7% preferred return, depending on capital committed. So more capital committed is a better return. Mm-hmm. To incentivize that, and 50-50 above, as I said. And those are the fees we're charging. I think in the future, because of this partnership that we've got that's just pumping us deals left and right, probably going to do away with the acquisition fee because we just won't really need it to happen, and it'll be better for the investors.
Okay. A question here regarding inflation. Can you, in the event of inflation, will that reflect in the leases or at the moment of sale only? How do you protect yourself against inflation? Is it in with the leases or?
Mm-hmm. Yeah, all of our leases right now are 2 or 3% escalators per year. And I would not want to sign a lease that had less than 2% escalator. I might think about 1.5 if the lease was already above market rate. But then I might not buy the building anyway. So yep, escalators on the leases. And then some leases that we have right now, when they sign a renewal, so, you know, a 5-year renewal, we'll assess fair market value. And if it's below fair market value, we'll bump up. And if it's below fair market value, we don't bump down, which is nice. Yeah. It's like heads you win, tails you win.
Yeah. Awesome. Yeah. There's a question from Richard. What was your going in cap after the contract versus published? I don't know if there's a specific deal. Richard, if you want to unmute, if it's just a specific deal.
Yeah, I was just trying to understand, like, more like the value add that you were able to gain through the lease negotiation versus what they were asking as the cap rate on the marketing materials, just to see how much, you know, you were able to gain before you even closed.
Yeah, sure. So I guess, so one example of this would be going in, they're asking an 8 cap because they don't have that long left on the lease and they don't want to be the ones to extend it out. And then I negotiate them up to about a 9 cap. This is a deal I have going on right now. I negotiate them up to a 9 cap. So my going in is a 9 cap. And then I've negotiated a 3-year triple net lease, or sorry, 5-year triple net lease with 2 5-year extensions, which, isn't the absolute gold standard of 15 or, even 10 years, but it's still a lot better than what they had. And if I turned around and wanted to sell this and I went through a broker with a national reach, national connections, I could probably get, my guess would be somewhere between 6.25 and 7, probably around 6.5 cap.
Right.
So
That's
in terms, yeah, it's a great spread. So I guess my negotiation, I'm adding an extra % there, and then the lease, I'm, getting a 3-point spread.
okay. That's fantastic. Thanks.
Yeah.
Awesome.
Clarifying that.
Good.
Okay, I have a question from Walid. Sounds like most of the places you are looking at are occupied. How much weight are you giving in terms of underwriting the property versus the tenant? And a follow-up, would you consider a vacant property?
So first, how much weight? We try to keep it 50-50. I have observed that one of our biases is to look at the tenant a little bit more than the property. And I've been working with my partner to make sure that we're keeping closer to 50-50. And one thing that's going to really help that is in this, in our partnership with Montecito Real Estate, they have institutional level data that they can provide us, even though we're a small company and would not be able to afford a national subscription to like CoStar or Reonomy or those large platforms. And so they're able to share that with us, and that's really helping us underwrite the property itself to the level that I want it to be underwritten. And then the follow-up, would I consider a vacant property? I would not buy a vacant property. I would buy a vacant property if I had a tenant who had signed a lease subject to their tenant improvements being done, and then I would run that as a value add. And that would be a bigger value add. That that would probably get me to 18 to 20% IRR. But I wouldn't buy a vacant property, especially these days, without a tenant in mind.
Which leads me to another question, which is, do you offer tenant improvement allowances or free rent?
Tenant improvement allowances.
Okay.
Yeah, I would rather that the space is improved.
Mm-hmm. Mm-hmm. Makes sense.
And I'll just add, because medical offices don't really move often, and it's so expensive for them to move, I can offer a tenant improvement allowance, makes the building nicer, and they like it just as much usually because they know that they're not really going to move.
Awesome. So from Bill, we have, what would be an example of some hidden problems that a new medical real estate investor should be aware of when buying their first property?
Some hidden problems. I'll give you 2 for now, and then always happy to touch base if you're gonna go out and buy a property. Like if you're actually thinking about this, I would be absolutely happy to talk to you about a specific property or just in general. The 2 I'll mention right now is, first, what is the practice demographic? And so what I mean by that is, I wouldn't buy a pediatrics clinic in Florida near a bunch of retirement communities. And I'm sure you could find one of those to buy, and I wouldn't buy it. It might be fine, it might be good enough, but just the demographics don't tell me that it's going to be a strong practice. So that would be one. The other major one that I would look into, that I would be very aware of, is that the income of the property, or the income of the tenant rather, is based in the doctor or the doctors there. So if you're going to buy a property and there's only one physician there, a heart attack could eliminate your source of rent, right? So I won't buy a property where there's only one doctor, and I'd really rather not buy one where there are two either. I want three or more. And I want them, as I said, I would like them to be on the younger side. I don't want them to be about to retire. And the last thing that I want, in particular, where I can really run afoul, is there needs to be an office manager. I do not want a practice that is run by the doctors who also are doing the healthcare, because that just doesn't work well. It's not efficient, and any responsibilities that the tenant should have for maintenance are going to get deferred to oblivion. So make sure that your physician tenants have an office manager, and that is their job to manage the office.
Okay, great.
Phenomenal.
I got one last question. And I just want to say it's the beauty of having a podcast with a live audience where everybody's muted, but they contribute through the chat. So the last question is, do you find sellers amicable to letting you negotiate leases prior to your deposit going hard?
Yes, I have found that. There are also enough opportunities that I can just pick the ones where that's the case. And kind of the two things that help me here briefly is one, sale leasebacks make it really easy, especially if it's one doctor or one person within a building of multiple tenants selling as a sale leaseback. And so like the one where I was today, Long Drive, I talked to a doctor who owns his whole large building. It will probably be a $3 million purchase. That's the one where I'd have to negotiate all the leases. He's going to do a sale leaseback, and so will everybody else in the building, and he knows that, and so he's amenable to doing that. The other scenario is those old, tired, retiring boomers primarily, who just, they own it free and clear. They're going to get 100% of the sale proceeds, and they just don't want to deal with re-signing a lease. And so they say, whatever it takes to get this sold, go ahead, take your 120 days to negotiate a lease.
Okay, well, that's pretty awesome, I think, for a first episode. Jacob, thank you for all the value you've brought to the audience and to us. I really enjoyed it. Logan?
Yeah, thanks for having me.
That was phenomenal. Thank you. So I'm guarantee everybody learned something today, and I appreciate it. And I know I learned several things. So thank you.
Yeah, me too.
Yeah.
So that was Jacob from Fall Creek Partners, and how can people get a hold of you? So because you offered to talk to people, so how can they actually get a hold of you?
Sure. My website is fallcreekpartners.com. My email is jacob@fallcreekpartners.com. And you can find me on Bigger Pockets. You can probably also find me on LinkedIn.
I have one more question before we let you go. We never pronounced your last name. And how do you pronounce your last name?
My last name is pronounced Cytrynbaum. Sorry, Cytrynbaum. Choked on my own last name.
If you can't say it, you can't hold us to it. No. Jacob,
yeah, exactly.
Awesome. It's been great. Thank you.
Okay, well, thank you, everybody. And you'll be able to connect with us on the show again in 2 weeks.